What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Michel Dilmanian, portfolio strategist at the BlackRock Investment Institute. This week, we focus on the jump in global long-term bond yields. Surging bond yields around the globe represent a big shift toward our view. We are in a world of higher interest rates relative to pre-pandemic. Markets have now come around to our view that inflation is poised to persist and that the Fed is set to keep policy rates higher than pre-pandemic levels for longer. The yield surge is not just about inflation expectations. Real yields on inflation-linked bonds have been the main driver. Investors are also demanding more compensation for the risk of holding long-term bonds, with term premium on 10-year bonds the highest in a decade. We don't think we've ever seen today's combination of sticky inflation, higher policy rates, and high and rising debt levels. Higher rates and U.S. policy uncertainty could make investor appetite for long-term bonds prone to shifts in sentiment and perceived risk. As policy changes play out and bond markets absorb record treasury issuance, we see room for long-term yields to head even higher. Even with higher interest rates, we still think stocks can keep pushing higher, yet much rides on earnings staying strong. Early signs are positive. Earnings are projected to grow 13% in 2025, up from 10% last year. We watch Q4 earnings season for signs of this bearing out. Here's our market take. We think bond yields can keep climbing, a reason we stay underweight long-dated U.S. Treasuries until a more attractive entry point develops. We stay risk-on as we expect artificial intelligence beneficiaries to broaden to sectors beyond tech. Yet we eye triggers to change our view. We stay overweight UK gilts for income, yet we monitor the UK's outlook as it faces the sharpest trade-off between growth and inflation among developed markets, in our view. Even with the recent jump in bond yields, credit spreads have held up well. We prefer short-term bonds for income and euro area over US credit. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This material is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com